You're about to join Niels Kaastrup-Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Alan Dunne and I, Niels Kaastrup-Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. If you're new to the show, I hope that today's episode will trigger your curiosity enough to check out the back catalog and listen to the past episodes that you may have missed, like last week's episode with Jerry Parker, where we discussed the pros and the cons using different styles of trend following, and also how much risk he takes per market within his 200 market portfolio. I also would like to encourage you to listen to the midweek Global Macro Series episode that I launched with Gem this week. So the first episode was with Dr. Ben Hunt as our guest, and that was a fascinating conversation. Even though the topic of narrative is perhaps not so well understood, I do think it's a very important topic to get familiar with. And of course, I do encourage you also to tune in next week on Wednesday, where we will be hosting one of the world's leading geopolitical experts, Peter Zeihan. So that will be a not to be missed episode, so to speak. Alan, it is wonderful to be back with you this week. How are things where you are today? I see you're in new surroundings. It's very sunny where you are.
It is indeed. Beautiful sunny morning in Dublin. Thanks very much. Yeah, we moved house recently, so that's why you're seeing me in a new setting. So lots of boxes around me as well. But outside of that, everything is great. Good to speak to you again.
Yeah, no, absolutely. And as we were talking about just before we press record, your new surroundings, you do sound a little bit different today. So people will probably get used to the new sound of
new
Alan.
Acoustics, yes, exactly.
Until the bookshelves come back up again, I guess. Anyways, this week, of course, all eyes were yet again focused on the prospects of higher Fed funds rate and how big the steps are going to be and how many of them they're going to get in the next few months. There seems to be more and more support from within the Fed that 50 basis points hikes will be the order of the day, and to quickly try and get the Fed funds up to about 2.5% or so. Fed funds futures have priced in 50 basis points hikes between now and September, which begs the question why the Fed is dragging their feet a bit in normalizing interest rates. One guess would be that the committee has enjoyed having its cake and eating it too when it comes to the stock market, but that may be coming to an end given the price action of the S&P 500 over the last couple of days, which I believe has now officially reached correction territory, while the Nasdaq is probably in a bear market, or what they call a bear market by now, with some of the FANG darlings, of course, down significantly since their all-time highs. Over here in Europe, we seem to be taking a different approach to all the alarm bells ringing, with Madame Lagarde this week saying that the ECB will need to wait for the data to dictate what the central bank will be doing with its policy. Just as a reminder, the ECB overnight borrowing rate is still negative 50 basis points, despite year-over-year inflation of 7.5%. Not sure what data she is waiting for. Anyways, it is worth pointing out the way corporate bonds and the S&P 500 has been moving in tandem so far this year. Nothing that we haven't mentioned before, because we've actually highlighted this as a major risk to lots of portfolios around the globe. Positive correlation between stocks and fixed incomes tends to happen when inflation rises above a certain level, leaving those portfolios incredibly vulnerable, unless, of course, they have some truly uncorrelated investments in the mix. Not sure, Alan, if you can think of one of those uncorrelated investments, but I would like to hear what you've been focusing on the last few weeks since we last spoke.
I'm sure we will touch on some ideas around that as we go through the hour.
Yeah, I know.
But, no, very much the same as yourself, Niels, in terms of focused on just the weakness in the equity market that we saw really just yesterday. We've had this run up in bond yields for a number of weeks now, with the US 10-year yield getting up close to the 3% level. But for a number of weeks there, the equity market seemed to have held in reasonably well, even in the face of the geopolitical tensions and the war in Ukraine. So it had been surprising that equities had held up so well. And I had been reading some people suggesting, that people had been transitioning into equities as a hedge against bonds, which was a new concept for me. But all that aside, it does seem to be we're at the point now where whether it was the ramp up in kind of rhetoric again this week, 50 basis points you've seen baked in for the next couple of meetings, and talk now of even the risk of 75, which is absolutely phenomenal relative to the pattern that we've seen for the last number of years. So certainly looks very tricky kind of outlook for equities in the short term from looking at the charts. And as you say, a lot of the high growth kind of FANG stocks technically start looking very weak. Obviously, we had the big move in Netflix, but even the likes of Alphabet and Apple, Microsoft, they're all starting to look much more weaker technically. So certainly, I think interesting that this relentless rise in yields is now starting to impact risk assets just in the last few days. So I think that's very interesting.
Yeah, no, I completely agree. And another thing that came sort of on my radar this week was just the fact, speaking of things that have changed a lot, I think it was last summer, where when you search for how many trillions of dollars of debt was yielding negative yields, I think we got to like 17 or 18 trillion dollars worldwide. I think it's down now to 2 trillion.
Right.
I mean, so this rise in interest rates over the last 8-9 months or so, it has really made a change in the structure of many things. And as you rightly say, what's the spillover effect going to be? And of course, we suspect that you're going to see this show up in many parts of the economy, whether it's going to be housing or other things. And of course, on top of that, we still have massive conflict and disturbances to supply chains, which can put, even more pressure on inflation and therefore yields. In terms of trend following for the week, I would say I'm pretty sure in saying that trend followers had another positive week overall, mainly driven by the exact thing, namely the continuation of yields moving higher. But also now, something we will touch on a little bit later, the currency market starting to produce some interesting opportunities, and the dollar at the moment displaying some further strength, and that seems to have helped, I think, in the trend-following world. In terms of single markets, actually, I would imagine that some of the moves we saw in the currency sector, like the yen and also the British pound, by the way, was meaningful for trend followers. And it is kind of nice to see a different leadership when it comes to attributions away from just being energies, which has been quite dominant so far this year. In terms of overall sector attribution, I imagine fixed income probably was the biggest contributor for the week. Stocks probably flat, even though we did, as you say, had some sell-off and pressure in the last couple of days. And then commodities, probably one of the few weeks we've had this year where commodities overall were a little bit of a detractor in terms of performance for trend followers. There were a few exceptions when you look at the markets. I noticed that soybean oil and corn still did pretty well, but there we are. From my point of view, the trend barometer finished the week at a reading of 55. So it's still a positive territory, still suggesting that trend followers are making money. Obviously, we have another week of trading to do before April comes to an end. But I think so far it looks like it's going okay in that area. Now, we have a number of topics, Alan, that you brought with you, so to speak. Some of them I actually have no idea where you're going to go with that. So I hope you do, which we'll see. But why don't we just kick it off, and as usual, we'll see how we go with that. And we're actually going to start with just what I mentioned before, kind of the currency markets. I mean, maybe for framing the conversation, what I can say from a trend following perspective, at least, is that currencies have probably been the worst sector for most trend followers in the last 15 years or so. Perhaps as a response to the strong, quote unquote, carry regime we've had, where central banks have kept everything pretty much in check, and growth has been pretty well synchronized between the major countries in the world. With that coming to an end, at least in my mind, and probably something that started a year ago or so, we are seeing some interesting opportunities, as mentioned, in the currency market. So de-dollarization, Bretton Woods 3, those are some of the terms being thrown out. Tell me what's on your mind.
Yeah, it's interesting. I mean, we touched on this the last time I was on. We were saying interesting to see currency starting to look much more interesting. And that was back when, I don't know, when I was on, it must have been 4-6 weeks ago, dollar yen was around 119. It's now jumped up to just under 130, which is, a very big move in a historical context. So that was one thing. And then secondly, I guess in this period as well, we've had this emergence of the speculation around a new Bretton Woods, arrangement, a Bretton Woods 3 idea, which is really a very interesting idea. It's been put forward by this Credit Suisse strategist, Zoltan Pozsar, and he's kind of outlined his hypothesis about how the Bretton Woods system is moving into a kind of a new era, which I thought was a very interesting idea. And basically, if you think about kind of the historical evolution, we had Bretton Woods after the Second World War from 1945 to 1973, when the dollar was then taken off the gold standards and the Bretton Woods system basically disintegrated. And then you had a transition period of volatility in markets. And then we entered what's kind of been called Bretton Woods 2, which is, coincided with a period of stability in the global trade system as well. Obviously, we had globalization. We had China coming into the world trade system. We had, the fall of the Berlin Wall and a golden era for probably neoliberalism. So this, you had two things happening at the one time. You had the dollar then kind of coming back as the anchor. Why? Because you've had this global trade system where, emerging economies came into the system and they tended to recycle their surpluses into dollars. So this was the idea of Bretton Woods 2, that even though formally the dollar wasn't the anchor, it was effectively playing that role, because emerging economies had the global savings glut, as Bernanke called it.
But just to add to that, but I do think the reason why it became de facto backed by oil. So the link which all the countries need. So that's kind of helped it along to,
that's right.
to that role.
Yeah. And I suppose this was the other part of it, is that access to commodities was easy, and everything operated very very efficiently. Why? Because the oil producers were happy to recycle their surpluses into dollars, and everybody was happy to trade together. But if you look at that system versus, what's happened in the last number of years and how we may be transitioning into a new system, first of all, we started to have the trade war between the US and China, and that kind of put large corporates on notice that maybe they needed to reassess their supply chains, and that obviously got accentuated by COVID, and everybody's now thinking in terms of robustness of supply chains as opposed to supply chain efficiency. And now obviously we've had the war in Ukraine, and we've had, I suppose, what we're calling the weaponization of the dollar, and the fact that for one, these commodity producers such as Russia may not want to hold dollars, so that's one side of it. And then on the flip side of it, commodity consumers may not want to deal with so-called kind of rogue nations like Russia. So effectively, we're seeing this breakdown both on the trade side and on the monetary side, which as the Zoltan Pozsar's view is, this is potentially very negative for the dollar, and it possibly is heralding a new era where commodities are at the center of the system, and access to commodities is really important, and the financing of commodity trading is going to be critical as well. The upshot of all of that seems to be dollar negative. What's interesting, I suppose, when you look at the markets at the moment, is we're seeing a strong rally in the dollar. So what's going on? And I think it's possibly a cyclical thing versus a longer term structural trend that are kind of meeting head on, because the cyclicalities are certainly very, very positive for the dollar at the moment. And it's interesting, there are certainly historical parallels. I touched on when I was on the last time about how the dollar yen move has reminded me of that big run up we saw in the 1990s, where you had a strong dollar, you had a similar scenario, kind of a relative interest rate differential, and a big carry trade, as you say, and ultimately it took the dollar up to 147. And it seems at the moment that that's the big dynamic. The expectation of rate rises in the US. Obviously, the Bank of Japan have been intervening to cap yields in Japan, and they're obviously steadfast in maintaining monetary stimulus. So we've got this very clear and notable divergence in policy for the first time in a number of years, and that's propelling the dollar higher. And there's probably a parallel if you go back to maybe the 1980s. Everybody's talking about how we need to see the Fed stepping up to be Volcker-esque in their response to this inflation. And obviously one of the upshots of the Volcker tightening that we saw in the early 80s was a very strong dollar. So it was a period of lax fiscal policy and tight monetary policy, which propelled the dollar really to multi-year highs in the early 80s. And you had this sustained run up in the dollar until the Plaza Accord, I think in 1985, was reached. That was a G7 agreement to kind of cap the dollar. So I suppose where I'm going with all of this is that, having had a period of real boring kind of movement in currency markets and a lot of stability, now we're back into a scenario where people are wondering, how high can dollar yen go? Will we see the Bank of Japan coming in to intervene? We haven't heard that for a long time. Certainly, I think the last time they came in to sell dollar yen was probably, back in 1998, around 148. They have been had to sell yen by dollars at times, but certainly the fact that that's on the agenda, that the magnitude of the moves that we're seeing in currencies, and you could easily see a scenario where you get a big run up in dollar yen, and then the yen becomes very cheap, because actually with low inflation in Japan on a PPP basis, it's actually getting cheaper versus the dollar. So you could have a huge move up, and then the fundamentals may reassert, and then a big move back down. So I just think, as we've been talking about, currencies have been uninteresting from a trend following perspective, but we're starting to see it becoming much more interesting. And obviously the other element that we didn't mention was that we've seen a breakout now in the dollar versus the Chinese renminbi, which had again been really the strongest currencies probably across the landscape in the last while. So it's very interesting how you've got this cyclical versus structural forces at play here. On the one hand, this kind of ongoing discussion, are we going to move away from the dollar-based system? Is the dollar at risk? But at the same time, on a cyclical basis, the strength of the US economy and the prospect of much higher rates providing fuel for a very strong dollar rally at the moment.
Yeah, I mean, I've heard the call on in many different places of this, the dollar is going to collapse, and people have been saying that for a while, and so on and so forth. But I still struggle with, but what's going to replace it?
Yeah.
Right. And then they say, Bitcoin is going to replace it. Well, that doesn't seem to that's going to happen anytime soon. And then they talk about, central bank digital currencies and so on, which we haven't still really seen in any meaningful way, and certainly not in the West and all of that stuff. So, I mean, it's a little bit like when people say trend following is dead. I always get a little bit skeptical when there's too many people saying, well, the dollar is dead. And you can certainly also find people, experts, I would imagine, and one of them being the next guest on the Global Macro Series, Peter Zeihan, who really strongly believes that the US is in so much better position from so many different angles compared to China, compared to Russia, not least demographics, and also the fact that both the US itself can supply themselves with both food and energy, something that Russia, they can, I guess, in terms of energy and probably food, but they need a few other things, and China, they need everything. So I'm kind of open-minded. I guess I'm more open-minded about calling the dollar dead too soon.
I'm the same, and it's been it's, as you say, it's been a topic throughout our careers. I would say that the dollar is doomed, and obviously when we had the euro, people hurled that the euro is going to be an alternative, and that proved not to be the case. I mean, I think the share of euros in kind of global reserves went up for a few years and then trickled down again. And there is this challenge that, does China actually want to play the role of the global reserve currency, because to do that you have to supply renminbi to the world so people can accumulate it. But to do that, then you need to run a deficit, which is the US has been happy to do that, but China generally doesn't like it. They haven't fully liberalized their capital account. So yeah, it does seem to be a case of there is no alternative. Let's see. Central bank digital currencies could change the landscape, but we'll have to wait and see.
Yeah, I mean, again, just hearing you talk, there's so many things that kind of pops to mind. One is the thing about China, right? Where, as far as I understand, and this is also something that I actually think is quite interesting when you think about all the companies that we know in the West, and a lot of investors have been very happy to pay up in terms of price. As far as I can tell, these companies can't get their money out of China. And there's only one country in the world that is where you're allowed to get money out of China, and that's Taiwan. Because it's one way for the Chinese to maybe kind of slowly getting them more included in the club, let's call it that. So I'm really confused about some of these things, and I'm confused that people don't question mark, some of this where companies or change have huge amounts of investments and profits piling up in China, but they can't get them out. That's one thing. Well, anyway, can't remember my other comments to what you said, but
certainly, I mean, it's as you say.
Oh yeah, I know what.
Sorry, go ahead.
I was just going to, sorry to interrupt you, because I'm getting to an age where I'll forget if I don't just shout it out. I would be more concerned about the euro actually holding together through what is to come, if you believe some of these people about deglobalization and conflict and all of that, because at some point you would think that even within Europe, at some point when it comes down to will we have power in our light switch, or will we have heat in our houses, some policies will become much more focused on how can we save our situation rather than how can we save Europe's situation. So I would be more concerned about the euro holding together than the dollar breaking down.
I think you're right, and I think that's why we're seeing that weakness in the euro. That the question is the European industrial model under threat if the likes of Germany don't have access to cheap energy? That's been the base of it, and countries have operated on the basis of a globalized free trading world. If you take out key suppliers out of that chain, it will obviously, there'll be winners and losers, and some of the losers will be impacted more than others. And as you say, energy dependence in Europe, or certainly in Germany, is higher than in the US. And I think that's one of the reasons why we're seeing that downtrend in the euro that's been pretty much underway for a number of months now, but has certainly accelerated since we've had the conflict in Ukraine.
True. Although it has been incredibly slow, I have to say. I really think it's a struggle getting that euro down, even with everything that's going on. But we'll see. I mean, sometimes these things has a way to just be very slow until people accept that there is an issue, and then suddenly the floodgates open, a little bit like what we saw with the yen. Suddenly everything just went. So yeah, I'm optimistic in the sense that I think there's going to be lots of movement in many of these.
I think the other thing that's interesting is, if you went back maybe 10 years in our industry, you would have seen a lot more currency traders, systematic and discretionary, and people have just been. It's just been such a difficult space to operate in that a lot of those have been wiped out a bit. Just the opportunities weren't there in G7 currencies in particular. But certainly, from a macro perspective and what we're seeing in terms of volatility levels, much more interesting now, I would say, looking ahead.
Now, of course, you also mentioned earlier this thing about people moving into equities as kind of a hedge against inflation, maybe a hedge against their bond portfolio. And we often hear this term, Tina, there is no alternative. But of course, both you and I know, and probably everyone who's listening to us today, know there is alternatives. There is certainly one alternative that we've been talking about for the last 8 years on this podcast. So I wanted to see if you could talk a little bit about the performance that we've seen in trend following Obviously, you wrote a great paper a few years back that we've talked about a few months ago. But from a historical perspective, and maybe put the current performance in some kind of context in terms of what it looks like, and just to maybe attack the topic from a slightly different angle than what we normally do.
Yeah, no, it's interesting. I mean, it's for people like ourselves who monitor the performance of managed futures, trend following performance on a pretty much daily basis, it really has been one of those periods where these periods will come along, and then you're still surprised somewhat when you see them, in the sense that what's really taken me has been the consistency of the performance that we've seen. Very very often with trend following, you obviously get strong trends, but then you're waiting for the inevitable correction in markets and a bit of a give back. But it really has felt like one of those periods where we've had consistently strong. I mean, looking at performance, looking at the numbers, the SocGen Trend Index, which is an index of large trend followers, up 25% year to date. The SocGen CTA Index up 18.75% year to date. And I think why has it felt so consistent? One of the things that you see when you get into a better market environment for trend following is what you tend to see is a rotation of trends. And it's a bit like what we talked about before. You get a shift in the market dynamic and a move in one market, and then kind of ripple effects into other markets. So, we've been seeing, probably last year more commodities, then into the early part of this year it was more the short rates and the big volatility expansion that we've seen in the short rates, then back into commodities again, then more into long rates and into bonds, and then more recently it's been bonds and currencies and the yen again. So very often what you're seeing is, yes, maybe individual markets are having a move and a correction, but then other markets are coming in to make up for the fact that you might be seeing a correction in one market to give overall a very consistent return profile. So, I mean, looking at the numbers relative to the past, it is certainly a strong period of performance. I was actually looking at the numbers to see has that consistency been unusual versus the past, and I just looked at the daily data on the SocGen Trend Index, and this year there's been about 66% of the days have been positive, which is high. The long-term average for the SocGen Trend Index is 53%. So certainly went to a period where it's definitely been more consistent, but not unusually so. So it's kind of like it's felt probably even. It's felt unusually good, but we have had periods like this before. Certainly back in 2014, 2015, we had a period that's kind of very similar to the current period with, trends in energy markets, currency markets, and in bond markets in that period. So interesting. We're seeing a kind of a similar period now. We're seeing what's interesting is we're seeing a low number of kind of losses, of significant losses. So I was just looking at what's the number of one standard deviation losses. So one standard deviation on the SocGen Trend, I think it's about 83 basis points. And there's been 6 days of those or less, or those are worse, basically, this year. So again, not unusually low, but definitely on the low side. So, and I think that's to my point that when you get losses maybe in one market, they're being compensated by gains in the other markets. And then again, have we seen like a number of very big days? Yeah, we've had 21 days where the index has been up more than one standard deviation. Again, high but not unusual. So when I look at the overall picture, yes, it's a very strong period of performance. We have had stronger periods of performance in the index back in the kind of 2000 to 2003 period, but the index itself was much more volatile back then. So I'm not sure. It might have been that there was fewer constituents, or else that the constituents themselves were higher volatility managers. So you have to adjust for that. And looking at it on a kind of a rolling sharp basis, the current period is similar to kind of the 2014, 2015 period. So I would say, what do we take from all of that? Yes, it's been a very strong period, certainly an above average period for trend following, but not something that's been exceptional relative to the past. Not something you would say, this is really off the charts, but it certainly ranks as a really strong period of performance and a very consistent period of performance.
Yeah, no, completely agree with that. And thanks for doing that work in terms of digging out some of those statistics. It's not statistics that I follow that closely on kind of daily performance numbers, but it's interesting because just from, as you say, I look at these numbers every single day, and I had noticed exactly the same. The down days were generally smaller, and to me, that indicates that there's a lot of breadth in the portfolio, and therefore, in a sense, there's a lot of divergence going on in the markets, as you rightly said. Even if there was a sector having a rough day, like yesterday with equities, clearly a rough day, but it was compensated to a large extent by many other things. So the net for yesterday, I imagine, will be relatively small down day. So it is interesting, of course. So yeah, we'll see how long it lasts. I mean, as you said, it's not we're not by any stretch of the imagination at a point where it's unusually long. I mean, we've had December through April, let's call it that. That's 5 months in a row with positive performance. That's not extreme. We can certainly go for a few more months if it was. But this is the other thing, and even though I talked with Jerry last week about what he's aiming for, his dream of creating trend-following performance that is consistently profitable on a 12-month basis, which I don't know whether, of course we're going to get up there in terms of percentages for sure, but we're probably not going to get to 100% rolling 12-month period that's going to be profitable. That would be unlikely for a trend-following strategy. Maybe 24 months, certainly 36 months gets more realistic. But of course, deep down, it is a desire for most investors to have some kind of consistency in that. The best way, to some extent, of course, is to blend trend following with something else to achieve even higher consistency. But I think, to your point, that and to Jerry's wish, so to speak, I do think generally trend following is doing a pretty good job at delivering consistency when you define consistency as something like rolling 24 months or rolling whatever 36 months. People have to get away from consistency expecting monthly positive returns all the time. That's something we will never be able to do. But once you zoom out a little bit, it does become very consistent, and I wish more people could see that and not focus so much on the monthly or daily up and down moves, which is just noise in the big picture, really.
Yeah, I think the other exceptional thing that we are seeing at the moment is obviously that this strong period of performance has occurred in a period of rising bond yields, which is obviously something that we talked about before, that there was this perception that wouldn't and couldn't happen.
That couldn't happen. No way that could happen, right?
Yeah. So again, it just highlights what a ridiculous notion that was, because obviously what we've seen is big dislocations across many markets. And I think the other point is that when you get an environment where you have a number of different themes and narratives in the market, it's not just one story, but you've got commodities being influenced by individual, market-specific factors, and then, divergences impacting currencies, and then big macro themes influencing markets as well. That the more unique themes and narratives in the markets, that creates more distinct trends and lower correlations, basically across markets, which again provides more opportunity to deliver more consistent returns. So I think that's another part of what we're seeing in terms of trend following performance at the moment.
Yeah, no, absolutely. Now, the next topic you brought along kind of took me a little bit surprised because there's a few things here that I didn't expect on today's list of topics. Insights from Alfred Winslow Jones as feature in More Money Than God. So let's dive into that one. That sounds fun.
Yeah, well, as you said, I was moving house recently, so that meant unpacking all of the books and
the old books
and moving them all. And one of them I came across was the book More Money Than God by Sebastian Mallaby, which I'd forgotten I had. And once you start unpacking boxes, you immediately pick up the first thing you see and start reading it or looking and say, "Oh, I forgot I had that book." But what was interesting is, Sebastian Mallaby, he's a great author. He wrote a book on Greenspan as well, which I definitely recommend. It's one of the best books I've read on kind of, regardless of what you think of Alan Greenspan, it's a great perspective on the economic and monetary developments over the last 50 years. But he's an author who kind of goes away and takes on big projects and spends 2 or 3 years researching and then writes them up. So he did one on Greenspan, as I said. He's done one recently on venture capital, and he had done this one going back a number of years called More Money Than God on the hedge fund industry and big players, the big kind of names in the hedge fund industry. So the first chapter is about Alfred Winslow Jones, who was kind of the first person, credited with running a hedge fund. He called it a hedged fund back. This was back in the 1950s, 1960s. But a couple of things when I read the chapter again, it resonated with me, particularly in the context of the conversations we've been having on the Allocator series. So one of the things was, so he basically ran a long short portfolio, a long short equity portfolio. So he'd be long some stocks, short some stocks, and he'd probably have a net long overall. So very typical of a long short equity strategy. But one of the things that was quite innovative at the time for him was that he obviously he had the insight that there was no point in, say, having high beta stocks as shorts and low beta stocks or low volatile stocks as longs, that you're going to have a disproportionate impact from your longs or shorts. So he talked about the velocity of the stocks, which was basically his name for volatility. And his insight was you had to measure the velocity of the stocks to understand their market impact. So it was very, very much a very good insight for the era, and he kind of sized his support. It's basically what he was doing is he was volatility sizing his portfolio, which obviously is something that people in the CTA industry do now. But even still, it's something that it's a concept that maybe hasn't fully permeated the rest of the industry, I would say. And the second thing was that he kind of had the observation that there might have been a perception in the industry that you didn't want to hold really volatile stocks because they were too risky. But he had the insight, well, that's not right. You still want to hold some of these stocks, but it's just about the sizing. So it's Sebastian Mallaby goes on to say, well, this was actually ahead of James Tobin's separation theorem, which is the same thing. And it's the idea that the right way to run a portfolio is to basically figure out what's the right optimal mix of assets based on their returns and characteristics. And then the second question is how much risk you want to hold in the portfolio. So, a good mix might be, as we're saying, equities plus trend plus other assets and strategies. And some people might want to have that at a 20 vol portfolio, but for somebody with less risk, it would still make sense to be invested in all of those strategies, but still have the portfolio run at a lower level of volatility. So what really struck me about this was, this is the way he was running his portfolio back in the 1950s, 1960s, but that concept is still quite alien to a lot of people in the investment industry. There's still this perception that, if you go to a typical wealth manager, you'll say we've got 3 kind of typical templates: the low risk, the medium risk, and the high risk. And basically, low risk means lower equities, medium risk, more equities, and higher risk, more equities. So the lever for increasing risk seems to be purely on that risk factor, as opposed to saying, let's run diversified portfolios and figure out what are the best assets and strategies to have in the portfolio. And then the second question is how much risk to have, or how levered those portfolios should be. So I'm kind of curious why that concept still hasn't taken hold. Where all of that fits in, I think why it all resonated particularly with me at the moment is we've been doing the Allocator series, and one of the guests, or one of the sets of guests we had on, was Fairfax County, Catherine Molnar and Andy Speller are the CIOs there, and their approach to running a big public pension plan is very much that idea of having multiple risk factors in the portfolio, holding uncorrelated strategies and holding them in size. They also recognize that high vol can be a good thing, because high vol means a bigger impact on your overall portfolio.
In fact, they preferred that.
They prefer that, exactly.
Yeah.
So there's the concept, historically, you might say, well, you're a buyer of volatility. And if you say that to somebody, they say, oh, why do you want to buy volatility? But it's basically you're buying more risk, so it can have more impact on your portfolio. So I thought that was interesting how they were, the conversation I had with Catherine and Andy very much resonated when I read this again. Oh yeah, that's exactly what they're doing, but it's still an out of consensus type of approach to size portfolios and size exposures based on volatility and risk contribution, and also to be willing to go into higher vol strategies, and also have the conviction to hold things that are truly uncorrelated, because that's going to give you a more robust portfolio over time. And then you determine, well, how much risk that we hold in the portfolio. So I think lots of insights there, but a question as to, well, why is that still a relatively it's a non-mainstream of running a portfolio?
Sure, but I think it leads to also other questions, such as most investors, I think it's safe to say, would certainly perceive fixed income as safer than equities, right? Yeah. And if you look, and this is just another issue that I can see coming over here in Europe, if you see some of the European countries and you look at the pension system, well, some of them have, instead of a 60-40 portfolio, they've had an 80-20, but the 80 is the fixed income.
Yes.
And you just mentioned this thing about, well, you can have three choices: a safe portfolio, which is mostly fixed income, and a risky portfolio, which is more balanced between equities and fixed income. But you think about that in today's world, where long-term U.S. treasuries are down 35-40% in price in the last 8-9 months. European fixed income, at some point, of course, it's already started, but it's not to that degree, will come under tremendous pressure, I imagine. So I think we have to, and we've actually talked about this. I can't remember if it was you and I, but certainly on the Systematic Investor series, we've talked about this thing about maybe we need to redefine what we mean by safe assets. And also going back to the topic that I bring up from time to time, and that is, I think we've lost our imagination as to what markets can do. And I think we're going to be reminded of that. We've already been reminded of it if we look at oil in the last 2 years, from minus $37 to $130 in 18-24 months. That in itself is unimaginable by most standards, but it can happen. And I think we're going to see more of that. And this is, of course, why, certainly from my point of view, that I have this incredible love and respect for trend following, because the fact that we can adapt to these unusual behaviors without getting emotionally involved, by just following rules. Of course, the rules have to be solid, but I think I don't think we get, as an industry, enough credit for time and time again going through these never happened before type periods and still delivering either very attractive returns or relatively small drawdowns. We talked briefly earlier today about the FANG stocks. As if they were less risky than what we do. No, not at all. Netflix is down, 60-70% from its high. Facebook or Meta, as it's called now, it's probably the same. These are extraordinary losses by any means of the imagination. And you never see that in the trend following world. Yeah, sure, we can have a 20% drawdown or 30% drawdown, but they're relatively short-lived, and over the long term, the performance has for decades been positive, usually double-digit, for something that had similar volatility to single stocks, right? So I think I think there's going to be a major shift. I really think we're in a time where we have to shift the way we think about many things in life.
But it is interesting how that kind of way of running portfolios, it's still very much embedded,
right.
And even from a managed futures perspective, it's that has always been the philosophy. Vol sizing, looking at each of the markets, risk adjusting, holding lots of different markets, even if they are maybe out of favor, currencies haven't trended for a long time, but people still trade them because they know at some point you'll get to diversification and you'll get the opportunity. So that mindset of diversification, risk sizing, holding uncorrelated strategies has always been, or uncorrelated markets, it's always been very much part of the ethos and philosophy of managed futures and trend following. But again, it's surprising how that is still and using, deciding what's the optimal portfolio that you want to have, and then as a second question, deciding how much risk you want to have, as opposed to just assuming more risk means more equities. So yeah, I'm not sure why those ideas have been maybe a bit slower to take hold in some quarters, but certainly I think maybe we're at that point where people will reassess some of these portfolio construction techniques.
Yeah, I think it would be interesting to see whether in your conversations going forward, because you speak more with the allocators than I do to some extent, from a bigger portfolio allocation point of view. I focus obviously more when people get interested in the trend following side of a portfolio. So it'll be interesting to see whether you pick up a shift in that mindset. Of course, I do think change is difficult, and I do think that when you've kind of been brought up in one environment and you've been reading the same books and it's worked, frankly. I mean, the 60/40 portfolio has been a fantastic success in the last 20 years. So why would you change, right? So there has to be some kind of aha moment that kind of pops up for people to take that leap. Incredibly interesting conversation with Catherine and Andrew regarding their approach in Fairfax. And of course, there are a few more of those. Hopefully we can find them and,
I'm sure we will,
and speak to them, because I do think it's for other pension funds and similar investors to change their mind. I think they have to listen to or read documentation from some of their peers to feel it's okay, right? It's kind of, they need some kind of a seal of approval to say, yeah, if they can do it over here, it's going to be fine. You and I have talked about CalSTRS a few times, their risk mitigation bucket that came up maybe 5-6 years ago they started doing it, where of course trend following is a major part of that risk mitigation. When I interviewed Carrie Lowe, the CIO of CalSTRS, I think she said that 35% of that risk mitigation bucket was trend following. Of course, and then I think they actually had 40% in at the time in long dated treasuries. Well, that may have to shift as well, right? I mean, given what we've seen now and the direction of interest rates, so even that has to be maybe redefined. So not only do people have to have more risk mitigation as a theme in their portfolio, but frankly, maybe they have to simply accept that an adaptive strategy, a long-short strategy, a diversified long-short strategy is a better solution when it comes to risk mitigation. Back to the point we talked about, true low correlation or non-correlation is hard to find, but there are a few places you can find it. And then also, I think another thing, which I'm not an expert in, I don't know if you have a view of that, but of course, a lot of people have also been sold protection in the form of long volatility strategies.
Yeah.
The problem is they haven't really protected anything this time around. And actually the risk of the portfolio so far, although I think it's going to come in the equity space, but the risk of the portfolio has been in the bond space. And so there's been no protection. In fact, I think most long volatility funds are probably down for the year, while trend followers have delivered stellar returns, right? So it'll be interesting to watch and see how this evolves. Of course, the fear is that we can see a big inflow in the trend following space from some of these investors at the wrong time and for the wrong reasons, simply just doing it to be able to tick the box saying, yeah, we do have an allocation here, but not fully embracing it, not fully understanding it. And the first time trend following is going to have one of those 15-month or 24-month period where nothing happens and there's a few drawdowns, they're going to be out the door, just like it happened in 2010, 11, 12. That's the risk that I see.
Yeah, no, for sure.
But hopefully,
I
was just going to say, hopefully further education, as we try to do, as other people try to do, will mitigate that that reaction from investors. And because what we want to get to, frankly, is we want to get to a point where people just focuses on this as a core allocation. Don't try to time what we do. We can't do it ourselves. And people should know there's so much dynamic stuff going on inside a trend following portfolio in terms of increasing positions, decreasing positions. Okay, I understand that there are some of our friends who maybe do that to a lesser degree and only do it when they have new positions on. That's fine. That's another debate. But generally speaking, it's a strategy that adapts with the market conditions, and therefore we're going to be making all those adjustments, and people don't have to try and time their entries and the exits and all of that. They just need to keep it as a core allocation.
No, absolutely, and I think that's. I think you're right that there will inevitably be performance chasers come in, and
right.
That's what we've seen in the past. But as you say, it's about education. It's about understanding it. Because basically, what does trend following do when you combine it with other elements in the portfolio? It basically acts as a dynamic allocator within the portfolio. It increases the allocation to risk assets when they're in an uptrend. It reduces it. It gets you out. Gets short those assets. Brings down your overall risk exposure in a downtrend. So it's acting as a dynamic asset allocator for you. So that's why you don't have to try and tinker with asset allocation by adding it to a multi-asset portfolio. So it's just I think there has been good success in that message infiltrating the public pension space in the US. But definitely in certain segments, it's an underappreciated message that I'm sure it's a topic we'll come back to again, I'm sure.
Absolutely. Before we jump to a completely different topic, I think that also could be fun to hear your thoughts on. You had a couple of other guests on this series in recent weeks. One of them, very enjoyable conversation between you and Hugo at Rothschilds. I thought that was also another really fun and interesting conversation. And I think he was very generous in terms of sharing some of their own weaknesses, frankly, when it comes to making decisions and all of that. So what was your kind of takeaways from your conversation with Hugo?
Yeah, no, very interesting, and as you say, very very humble in terms of their recognizing the difficulty of doing all of this asset allocation, manager selection, portfolio management. So they're definitely not trying to say that they had all of the answers, but there was a few things that really stood out. Again, Hugo talked about how people will come in showing a strategy to be a high sharp strategy and thinking that this will really sway the investment team at Rothschild, when in actual fact they think if they see a high sharp strategy that's a warning bell for a strategy that's probably unsustainable and probably has some kind of short volatility characteristic, which again, absolutely true. And it's something that as an allocator we would always be screening strategies for are there short vol characteristics? And obviously you can generate a great sharp at times, basically, picking up the nickels in front of the steamroller until you eventually get the big blow up. So that was refreshing to hear that perspective. Hugo had some great metaphors as well. The idea of, you can be invested in, you have many different cabins, but they can all be on the same ship. The idea of you can seemingly look diversified in your portfolio. I think he had the experience of being back at Deutsche Bank and on their wealth management global asset allocation committee going into the financial crisis, and it looked like their portfolio was really diversified. You had equities and hedge funds and credit and real estate and all of these things. So you say, this is a very diversified portfolio, but of course they all were dominated by equity risk. So when the crisis came, the portfolio wasn't as diversified. So it's a good analogy that that too many cabins on the same ship, but you need to have different ships that are actually going in different directions at different times to be truly robust and diversified. So I thought that was an interesting one. Rothschild are interesting in that they're actually they're stock pickers as well as allocators. And they're kind of believers in value investing. At the same time, they're believers in trend following. So you might say, how do you marry all of that? But again, it's about having a belief in disciplines that they feel work over the long term, and having the conviction to allocate to them. So I thought that was very interesting as well. Yeah.
And if I can just add to that, and this is what I find refreshing in a sense, and that is being willing to accept the evidence, right?
Yes.
And not thinking that I know better or we know better, because as you and I both know, there has never been a white paper suggesting that an allocation to trend following in a portfolio of stocks and bonds would do any harm, right?
Yeah.
I mean, all the evidence points in one direction: higher returns, lower drawdowns, and lower volatility. Yet, that kind of evidence is still not universally accepted, of course.
Yes.
And I think that's what Hugo brings to it, and his team, is that they fully accept that evidence, and they're not going to spend time coming up with excuses why that's not the case.
Yeah. No, it definitely very much a focus on, appraising their decisions over time, I thought as well was really interesting. He talked about how, when they make a big decision, they'll write down their thought process at that point in time, because, if you decide to buy a stock or whatever, and the stock goes up in value, you kind of naturally forget all of those arguments that you had in your mind as to why it mightn't be such a good idea, that you think, oh, well, I kind of knew that was going to be a winner. But actually, if you have the discipline of writing it all down, documenting your thought process, then you can go back and say, well, actually, it was kind of a finely balanced decision. There were pros, there were cons. Overall, we decided to go with it. So it's a good reminder of how difficult all of these decisions are at the point in time. And also, they talked about being prepared and basically having a game plan, and not trying to, just react to everything that they know in advance. If you get a significant sell-off in certain markets, that this is how they are likely to react. So I thought... And
actually writing that game plan down, meaning that they would write in advance what they're going to do, in order, because they knew that once the time came and whatever they wanted to buy was tanking, that they wouldn't do it unless they had kind of pre-committed to doing it. Again, very, very much common sense, but very few people, I imagine, does it. When he mentioned that, when I listened to the conversation, he mentioned that about writing things down, having a plan. I mean, it is so much exactly what we talk about in the trend following world, right? That one of the strengths of what we do is always having a plan, always knowing what we're going to be doing, regardless of whether you have a massive crisis suddenly showing up. You know exactly what you're going to do. There is no panic. There is no doubt. And so actually I thought that, wow, that's amazing, because this is an argument we've been making for decades, that there's an advantage of being quote unquote prepared. But here are people who are actually doing it by writing down what they're going to do under certain circumstances, because they know they're going to be too weak as humans to do it otherwise.
Yeah, no, absolutely. And another point that was very interesting is, what really struck me is that, he talked about the downside of committees and having too many people on committees, and that
another refreshing thought.
One. What you can often get with an investment committee is, stocks are in a downturn. It seems, let's do the prudent thing and reduce our risk here, because it's just, there's too much uncertainty out there, and that can be a seemingly sensible thing to do, but actually, it's not driven by any investment insight. The investment insight is probably that could be the time to be increasing your risk. So it's that the people who are very good at doing this have an insight. The insight might be, okay, you hold uncorrelated strategies, or you volatility adjust, and then they have the discipline to apply that and consistently apply that approach. And that was another big takeaway that I took from the Ted Seides conversation as well. Obviously, he's interviewed tens and hundreds of allocators, and what distinguishes the really top investors. His perspective was, again, that combination of insight and discipline, that they had an insight as to how markets operate and how you can make money, and the discipline then to, carry through on that strategy consistently over the long term. So there's lots of ways. There can be many different insights, many different ways to run portfolios, but there has to be one. It has to be something that works, and then you have to apply it systematically and rigorously over time. So again, that's a theme that's coming up all the time in our conversations.
I want to shift gear before we close down for today, and I want to bring it back. And I have an idea. I have a feeling that you might have listened to the conversation. It's the one 2 weeks ago with Tim Pickering. Right. And because that was very much commodity focused, so super interesting to have Tim back on the podcast after a number of years. Obviously, the commodity space have become incredibly interesting again, but also recognizing the fact that when Tim and I spoke in December of 2014, I mean, pretty much commodities went into a bear market that lasted 5-6 years. Which brings me into a paper that TransTrend put out this week. And I have to be completely honest and say here that not everything that Harold writes, I'm not sure always I understand fully what he means. So I could be wrong here. But my feeling was when I read it that they were questioning, which I think is fair, and I probably would do as well, questioning this idea about getting exposure to commodities either via a long-only approach, like an index, that Tim's firm does a lot of, not exclusively, but they do a lot of that. And of course, there's been other commodity index providers, compared to having exposure to commodities from a long-short perspective, like trend followers do. I don't know if you have thoughts on that as such. I know you didn't have time to really read the article that they put out, but I don't think you need to. But again, when we go into this, what would I worry about that's happening right now in terms of decisions being made in boardrooms around the world, in pension funds and other institutions, is that there could be a sudden rush and say, oh, we need a commodity index so we can tick the box and can show up. We have a 5% allocation. So we're just going to rush into it, and it's going to be long only. And then we're going into another bear market for commodities, potentially. Who knows? So have you ever done any work in this area, or do you have any opinions about it?
No, I think you're right. I have looked at this before, and it's just interesting. I was looking at some asset allocation plans and doing some work on this recently. And, it's interesting how if you said to somebody now, well, should we have an allocation to commodities? I don't think anybody would say, oh, no, let's not have commodities. Why would you have commodities? But if you were to do that 5 years ago and you said, well, should we have 10% commodity? Well, like commodities have fallen for the last 10 years. Why would you have commodities? So it is interesting how just in the space of 2, 3, 4 years, whatever it is, everybody's perception, I think, would have changed around that. And, if you went back to 2010 or 8, and you looked at most people's asset allocation plans, they probably did include commodities then, and then they were out, and now they're back in. And that just reflects the fact that these markets tend to be very cyclical. So actually, I've done some work in this before, and what you find in an inflationary environment, and long only commodities will do better than managed futures or trend following. But obviously, in a non-inflationary environment, they will do a lot worse. So over the full cycle, what you get obviously with trend following and managed futures is the ability to manage a risk, that you can participate on the way up. But if you get a change in the cycle, and who knows how long this super cycle will, if it's a super cycle, or how long this cycle will last. You're basically getting a more managed way of accessing commodities by being allocated to trend following and managed futures. And it's interesting because if you went back a few years, most people allocated to trend following on the crisis risk offset idea purely as something that can do well in times of equity stress. But obviously, we're talking about the SocGen trend being up 25% this year. Okay, equities are down, but not dramatically. We're not in the midst of an equity bear market. We're in the midst of a bond bear market, and we're in the midst of an inflationary surge. So I think what my takeaway is, yes, if you had absolute conviction that commodities were moving higher for the next 10 years, and you had two choices, it was long commodities or trend following, yes, maybe commodities would do better. But in the absence of that complete conviction, trend following is a way of getting exposure should we have that multi-year rally in commodities. But if we don't, and it turns out to be not the case, that you will get a managed exposure, and you can participate, obviously, if it ends up being a maybe, okay, 2008, it's maybe too dramatic to say that. But if we have a scenario where the first part of the year is an inflationary surge, but the second half of the year is a recession, which a lot of people are forecasting, and commodities turn down, then obviously trend following will be able to adapt to that. So I think from a risk reward perspective, that's why trend following is perhaps a more attractive way of accessing commodities.
And there's another thing that's interesting about this is that usually people will get the idea of getting more exposure to commodities when they see the inflation numbers go up. But as you and I spoke about before we pressed record today, actually, when you see the inflation, commodities have actually already gone up because they're typically the ones causing the inflation. So they've moved up for months by the time they show up in the CPI numbers and so on and so forth. Plus, those numbers are, obviously manipulated in many ways anyway. So it's kind of a little bit of a silly thing to say, oh, I'm going to hedge against the inflation we see now by getting commodity exposure. Well, you probably should have thought of that before you even saw any inflation in the numbers. So I think that is a challenge.
For sure. Yeah, we've already had the inflation in the commodity features.
And the difference being, Alan, between having a core allocation to commodities in your portfolio and also a long-only commodities allocation and having a core allocation to trend following is also because we have all these roll yields, et cetera, that just depletes the performance of long-only commodity indices. A lot of them were down 60, 70%, I think, from memory, before they turned in 2020 from their recent high. And we already know how difficult it is to keep investors interested if you're down 20%. Yes. So I can't imagine how impossible really it is to keep them invested if you're... Plus the fact you have to make up so much money. We're going back to the compound effect of making an investment. If you're down 60%, even if commodities looks great, they're up 50% in the last 12 months. Well, I mean, you're not even back to break even at that time. So... I don't want to sound too negative on long-only commodities indices and so on and so forth. I do think they can play a role, but I really like the actively managed side of commodity exposure that you get through trend following a lot more anyways. Another thing that I thought has been quite interesting as well is that one of the themes that our next guest on the Global Macro Series, Peter Zeihan, has been talking about is this, that we're entering a world of deglobalization. You and I touched on this when we talked about, the Bretton Woods 3 and all of that stuff. And one of his points really is that in a deglobalizing world, anything that's worked in the last 30, 40 years, this is going to be like playing the film in reverse. So anything that's worked in the last 30, 40 years probably won't work well going forward. And of course, if we think about it from an investment point of view, that could easily mean things like risk parity, private equity, just to name a few. Whilst on the other side, which we, I think, have been openly admitting that the last 20 years have not been as good as for trend followers as the 70s, the 80s, and the 90s. So maybe these divergent strategies, there's another argument for why a deglobalizing world will be much more conducive to trend following than the globalizing world that we've been in, and especially in the last 20 years, which then became kind of this massively carry-focused world with stable central bank policies, etc., etc. Another thing, I don't know if you have any views on that, just because it's happening, I think, tomorrow. We have a French election. Another thing that could...
No insights on particular insights on the French election.
No,
but I do agree with you on the deglobalization, and I think another thing that is interesting there that isn't unknown. We've seen this huge growth of the private markets and private debt, private credit, and a lot of people have seen this as a substitute for government bonds. But one thing I'm wondering about, and I haven't researched this enough yet to have any clear view, but it is a concern. Obviously in a typical downturn, those credit losses, bankruptcies, etc., the losses will accrue in the banking sector, and you could say, well, that's systemic. But at the same time, it's easy to identify who these people are, and you can bail them out. But in the next downturn, who will be assuming the losses from corporate defaults, bankruptcies, etc. And is the systemic risk different potentially going forward? So I think there's been this huge flood of money into the privates, reflecting the low rate environment, and as you say, which is a byproduct of globalization. Looking ahead, how will that play out in the next downturn? I don't know, but I'm very, very interested to see how that plays out.
And the beauty is, as trend followers, we don't need to know. So that's, let's leave it with that. That's a good way, I guess, on ending our little trend following talk today. You've already done part of my work here, Alan, because you already talked about year-to-date performances, but just because it's part of my usual spiel, Beta 50 index is up 5% in April so far, up 14.54% year-to-date as of Thursday. SocGen CT index up 5.25%, up 18.71% so far this year. SocGen trend index up 6.66%, up 25.73%. as of Thursday, and then the SocGen short-term traders index up 2.2%, up 7.84% so far this year. MSCI World Index down 5.59% in April so far, down 10.8% year to date. And the World Government Bond Index down another almost 3% this month. I don't even have the year-to-date number, but it's not looking pretty. I think it is the worst start to any year really in the fixed income sector. So there we are. We're going to wrap up this conversation. Of course, we hope that you enjoyed it. If you did, please share these episodes and please rate and review them in Spotify and in iTunes. Next week, I'm going to be joined by Rob, who's back after his extended Easter break, I have to say. As always, it's going to be a fun conversation. I'm sure there's a few topics he wants to comment on that we've been speaking about in the last few weeks. You can email the questions that you might have for Rob, info@toptradersunplugged.com, and we'll do our best to bring them up. In the meantime, I would just need to finish and say bye from Alan and me. Thanks so much for listening, and we look forward to being back with you next week. And in the meantime, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.